the character, the leadership of this market has kind of switched back and forth quite a bit. Obviously, growth led into, 9 months ago, been a big value rally. But in recent months, it's actually been a little bit more nuanced than that. It hasn't been clear one way or the other. And there's also big profitable growth companies, and then there's more speculative ones. Where do you think this all shakes out in terms of Fed policy, at least getting toward that tightening moment down the road, and what it means for growth stocks, for example?
Well, what you say is correct, that there's been this shift recently. So what has happened over the last month is that the top performing stocks of the largest cap, if you take the 50 largest cap names in the S&P, they had been cyclical stocks. They had been energy stocks, financial stocks. The big reopening play and value play had been going on for the first 5 months of the year for sure. And then over the past few weeks, we've seen names like Facebook, Nvidia, PayPal, Google, which had been strong. They have taken the lead. The top of the S&P of the largest weight stocks, performance-wise, have all been technology or digital players. And that says that it's an economic growth story. Interest rates are manageable. These are not companies that need to borrow a lot. Interest rates may go up in 2 years or even a year from now from very, very low price, very low rates. And so that's not a major concern to the growth aspect of these major players. And that's a change in the market. Of course, their PE had been coming down, their prices had been weak, and it makes sense that they start to catch up. It's more of a stock pickers market also, and we're leaning away from the highest multiple of sales stocks that were really driving a lot of attention in January and February, as part of the Red Book. AMC, GameStop, Snowflake, Teladoc, all those companies have begun to come down. This is a different kind of market, and I think that the Fed's reiteration of sort of calm, the economy is growing very fast. Yes, we have inflation, but we're addressing it, and it's mostly transitory. Makes a lot of sense.
Yeah, obviously, NASDAQ valuation's down, so its sensitivity to maybe moves in yields is a little bit diminished. Joe, just tactically, or at least how you'd want to assemble a portfolio, you talk about this creating an opportunity for maybe another leg higher. What would be emphasized in such a move like that?
Well, Michael, dispersion prevails so far year to date. So when I look at the S&P sectors, the only sector that I want to overweight is diversification. I want to touch all of the sectors. I think it's important to look at the 2- and 10-year spread. We've seen that spread, which was 160 basis points towards the end of the March. That's come in towards 130. I'd like to see a little bit of a steepening there in the yield curve, so we could gain confidence that financials and cyclically oriented businesses, where I think you should be, will gain some of the positive momentum. I also thought yesterday Jim Cramer introduced a very interesting thought, and that's that I think markets need oil to retreat from where it currently sits at $72. Since May 20th, oil has rallied 16% from 62 to 72. But investors are not getting paid a similar type of return. The XLE has only gone up half that, 8%. So is the higher oil price above $70 beginning to impact both consumers and corporations? We'll find out in the upcoming earnings. But I think there's a formula here that we need to increase the investor money flow. And we got the first needed step yesterday with a better aligned policy from the Federal Reserve.
Shepard Smith here. Thanks for watching CNBC on YouTube.